Welcome, everybody, to another episode of the Good Deeds Note Investing Podcast. I am your co-host, Chris 70, along with the full-headed hairman, Jamie Bateman. Jamie, how are you today?
I'm doing well. I figured, you know what? I'm 46. The gray is coming in. Let's just own it.
So I'm 46 and a half. So
you're always one step ahead of me.
Yeah. So yesterday was actually my son's like half birthday. So he was all excited. He's like, oh, I'm a half now. So
nice.
But I'm sure people don't need to listen about that. So today's topic, Jamie Bateman is going to discuss, and I'm going to critique and spitfire at him questions and comments regarding his upcoming presentation for the Cash Flow Expo. If people are not familiar with it, it is numerous speakers, probably 20 to 30 speakers, all talking about different topics and notes. And you can learn more at cashflowexpo.com. But before we get into that, let's dive into our typical what just happened so far this week. Jamie, I'll let you go first.
Let's see. I'm just got an offer in this morning on a property in New York that it's very likely I'm going to be losing money on this one, but it's just a matter of how much. And don't get me wrong, this portfolio of New York loans I'm going to make out on, but this one just with back taxes and the property, it's a total teardown. And yeah, we'll see. I'm going back and forth with this. I got a formal offer, but now I'm saying, look, you're responsible for back taxes and everything else. So, because I don't want to have to come to the table to close this. So there is that. We'll see where that goes. I am using an REO company that I was recommended by Andy Mirza, and so far they're doing a great job. Trying to think what else is going on. Got a lot of different things floating around, as is typical in the note space, a lot of moving parts. Yeah, what do you have going on?
So I got a payoff yesterday on a loan, which is nice, of course, to always receive payoff.
Yeah.
I had
was that a performer or
it was
NPL?
a performing loan. It had about probably $10,000-$12,000 balance. It was actually a CFD we converted to a note. So now that I think the borrower, took ownership and I converted it last year, they probably were looking to refinance. So good for them and basically good for us as well.
That is, it makes it a lot easier to refinance. It's pretty much impossible, I think, if it's a CFD. So
yeah, it's much more challenging.
The title's not in their name. So yeah, that's cool. Nice.
So got that done. Let's see. So we talk about on a prior episode with Shante about HELOCs and foreclosures and so forth. So I started some legal on about a dozen loans. Mostly these are non-owner occupied or vacant properties that the borrowers no longer are interested in the property. So we've tried to work, out ways for cash for keys or something, but just been non-responsive. So we are, going down that process. But I literally had to wait 6 months because we could not get the servicer the proper information. I'm sorry, could not get the attorney the proper information because the servicer who had it at that time kind of didn't know how to provide the proper information. So extremely frustrating, but thankfully Shante took care of me there. And let's see, what else do I have going on?
I can chime in. I remember the other thing that I've got. It's also a New York loan. We had a deadline for a mod to be accepted. We were going through mediation and headed for foreclosure. And then I posted something in the Facebook group about New York full steam ahead as far as the moratoria being lifted and that kind of thing. You can move forward with foreclosures and evictions. So I think that puts a little more stress on the borrower at this point to come to the table. This loan, there had been zero communication for a year, just refusing to communicate. And then now they just accepted. I gave them 3 options. I recommend this. I guess I should save, I'll save that for later. But so borrowers came to the table and are going to put down a down payment and sign the mod and move forward. So that's good. We'll see where it goes. But this one I think could make up for the previous one I mentioned as far as the loss goes. So
is that the one where the borrower, when I sent somebody out to take photos, came out with a shotgun?
That's a different one. And that's the one I was referring to. There were on the Shante episode, there were statute of limitations issues.
Yep.
So that one we did mod. There's still some issues with it, but I've actually done quite well with the modifications on these New York loans. And actually, that's one thing I was going to mention. This is the Good Deeds podcast, and I've been thinking about this a little bit. People, I think maybe if you listen to us, it's all, we talk a lot about foreclosures, and obviously that's a key piece if you're going to be a non-performing loan investor. I don't want people to think that's like the goal, or, you can only work with somebody if there's communication, and most of the time, that you're not getting anywhere. If you're, you can go ahead.
Yeah, and that's kind of like when I mentioned, the ones I'm doing with the lines of credit and stuff. That's why I mentioned, and I didn't, I'll reiterate it. These are, most of them are properties now that are now vacant in their blight, and part of it, the issue, the thing to consider too is, and you're doing a good deed by trying to take it back because you're trying to do something with the property. Right now, vacant properties in neighborhoods are typically areas for either crime, drugs, or whatever the case may be. You take these back, try and get them, sell or finance them to a fix and flipper. We're trying to improve the neighborhood.
Right.
These aren't owner occupied where somebody's missed a payment and I'm like, oh, I'm coming after you.
Yeah.
I had somebody reach out to a colleague that I know that basically wanted to foreclose on somebody because they missed one payment, and they were adamant, like, I don't care, I want to foreclose. And it's like, well, first off, that's shouldn't be in this business if that's what you want. But in the same token, it's not going to happen. But seeing you took up all my time for what just happened to me. But I will mention one other thing. Jamie and I are doing some due diligence on a New York loan that's got kind of some interesting situation to it, where the mortgage basically needs to be reformed, which means the mortgage has the wrong legal description. So as part of the foreclosure process, you have to do what's called reform the mortgage, which is correct it from that perspective. So that is creating some challenges, because if it's not allowed to be reformed, it can present significant issues. Now there is title insurance on it, so I'm not sure how that will play into it, but we are just, we're rolling up our sleeves and kind of getting educated on a daily basis on this. So
there are a lot of moving parts with that one. The legal description of the deed did not match the legal description of the mortgage. So the current note holder filed an amendment to or a motion to amend the complaint. And now that's sitting in the judicial system. So we'll see what the ruling ends up being. But there's no shortage of stuff to learn in this business. That's for sure.
So, Mr. Bateman, let's get rolling on your presentation, which it is on.
It's on what is it Notes for Newbies. And this was one of the, I think it was the third most popular episode. Katie, who does some marketing work for us, she interviewed me on the podcast a while back, and people seem to like that episode with that. So it was meant to be a Q&A for newer note investors, and I'm going to kind of fly through it. Since we don't have all kinds of time.
I just want to say that when you look at like the top 5 episodes from last year, basically number 1 was with Shante and Beth. Number 3 was your episode with Katie, and number 4 was my episode with Lauren. Because we need to have more women on, Jamie, is what I'm getting at. People listen to you and me talk all the time. It's like
I just looked at the more recent numbers, and Sandra's is number 1.
So I mean that one, that one hasn't been on. If we look at the last, I'm looking at the last 2 months.
I think she's already moved ahead of some people who could have been first. So you're absolutely
actually
right.
Debbie Mullins so if we go to December 1st, Debbie Mullins is number 1.
Okay.
And then Sandra is already moving up, and hers is very recent as well.
Right.
She's already in the top 5. So
Are you firing me and bringing Gail back? Is that what's going on right now?
I was wondering if you're going to fire me and throw in I was wondering if you're going to fire me and bring Sandra back in. So,
well, I mean, if we have any, female note investors who want to come on, please reach out.
I mean, we could just have Sandra. Actually, you know what we should do? We'll have Sandra and Lauren do an episode.
There you go.
Sandra works for Jamie and Lauren does, stuff for me and stuff. So I think we have them come do an episode. I'm going to talk to her. I have a call with Lauren today. She doesn't know this, but now she'll know that she's going to have to come host an episode. And you know what we should do? Have them pretend they're us. Have them imitate us. That would be awesome.
Oh my gosh. Yeah. We're getting creative now. All right, I'm going to start.
Yep,
so I'm going to skip the part about meet me. So basics of mortgage note investing. Mortgage notes are a niche within real estate. A note is a promise to pay. These are real basic stuff, just basic topics to make sure everybody's on the same page. You can go back and listen to some other podcasts and read blog posts that we have about the top 10 reasons to invest in mortgage notes. And we also did one on top 10 reasons not to. Active versus passive. Go ahead, Chris.
So sorry. So first question I was going to ask is, of the basics, what is like the first thing people should understand or most important thing to learn, early on, you think?
If, to be
like somebody that knows nothing,
So I would say, sure. So yeah, I was skipping over that in the interest of time, but I guess you're right. So a note is a promise to pay. So I think most people are familiar with a loan, right? Either on a car or an unsecured loan or a mortgage. Most people at least are familiar with what a mortgage is. So the note itself is a promise to pay. So it spells out the terms. Chris, you're the lender. You lend me $1 million to go buy my, my second home. And I promise to pay that money back over time. So the note spells out the terms of that loan. Go ahead.
So no, you're giving a Chris answer that you're going on forever.
Yeah.
I was just more actually the answer, I think, in yours telling it is people need to understand the difference between a note and a mortgage as they are two separate instruments.
So the mortgage,
we don't need to go into detail on it. Just kind of people can go watch other episodes. I was just curious. That's the first thing people should understand. I'm sorry.
So a note and a mortgage are two different things. And a mortgage, it's called a deed of trust in certain states. Georgia might be a security deed. There I go, going down the rabbit hole again. But a note and a mortgage are two different things. The mortgage secures it links the note to the collateral. And in this case, the collateral is the property. So mortgage is a security instrument that links that promise to pay to that collateral. Lots of reasons to get into notes. A lot of people like the fact that you can control the property without owning the property. And so it can be considered a little more passive, a little less, less liability than maybe owning a rental property. And we'll get into some of this active versus passive. Do you want to invest in notes or do you want to be a note investor? I think you've talked about that a bunch of times, but do you want to dabble, have a performing note in your IRA, or do you want to actually be a note investor and run a note business? I mean, there's all kinds of gray in this business, and people love to put everything in black and white, but there's a middle ground where it's kind of passive, kind of active, in my opinion. Performing versus non-performing. Performing essentially is the borrower is making payments on time, and non-performing, they're not. And so, yes, sir.
What if it's 60 days behind? Where do you consider it?
I would call that a sub-performing loan. And that gets to my point of there's a lot of gray in this industry. Even though we just like the two categories of performing and non-performing, because it makes it easier for bidding and easier for communicating, you gotta dig a little deeper and say, look, were they performing for 10 years and then they just missed a payment and there's, two payments and they're 60 days behind? That's probably closer to performing. But if they just, reinstated 3 times in the last 3 years and they're 60 days behind, I'd call that non-performing. So it depends. Generally speaking, if I have to give a clear-cut answer, I say 90 days is kind of the cutoff where it's non-performing. What would you say?
I think you gave the right answer. It depends. If the borrower missed two payments and keeps paying, but they never fully paid up, but they're making the payments, they're performing, they're making payments. If they're just not paying and they'll pay like every 3 months to catch up, I typically will treat that as a non-performing loan, even though they're constantly 60. They miss 3 months, they'll pay 2. They'll miss 3 months, they'll pay 2, or they'll miss 3 months and pay 3. But they're constantly not consistent. To me, I break it down to, are they paying consistently or are they not? And if they're, so are they consistent or are they not consistent is another way to be performing or non-performing, to kind of really break down some of that gray.
Yeah, I've got a case study here that is a pretty good example of what I would call a sub-performer. But we'll get into that. So note investing advantages, a few advantages. It's an investment that's not tied to Wall Street. And right now, who knows when after this comes out, what the market will look like. But in the last week or two, there's been a lot of volatility with Wall Street and crypto and other things. And so I've actually noticed an uptick in people who have reached out to me. And I don't know if it's related to this for sure, but people who are reaching out for an alternative investment that's not tied to your typical, the stock market.
So Jay Scott, I believe.
Yep.
I
mean, I know who he is.
Who he is. Yeah,
I think we're Facebook friends, so I guess that means
he's bigger pockets. He's written, estimate like books on like rehabbing houses and stuff. But he's a real estate investor, and he posted, his thoughts on economy yesterday, and there was some stat that was basically like talking about bubbles and things overpriced. And one of them was kind of tied to the stock market, in that typically there's some ratio that typically stays around like 100 to 120%. And in extreme cases, like in 2008, it got to 150, which caused kind of everything to get back down to normal. It may have been, I forget what the exact stat was, but in today's environment with the stock market, it's at 200%. So it's like blown away everything. So his basis is, hey, real estate's a little different animal because of it is getting less affordable, but also there's less amount of housing. So, there's rent and stuff, but basically from a stock perspective, kind of what I read from that graph is stocks are extremely overpriced right now. And I actually haven't looked at the market for the last week. All I did is saw something on Facebook that Bitcoin was down in like the mid to high 30s, which it was at like 75,000 or 70,000, a month ago. But of course, right before the COVID hit, it was only at 5,000. So, that's a whole nother animal.
And actually that's true for me too. I don't really track the markets at all. I mean, I pay attention to kind of headlines and articles like you just said, but this is mostly from people I follow on Twitter who are both in crypto and stocks. But, and it's funny, the whole thing with these kind of, I guess, younger investors love to say, buy the dip. And it's like, it sounds good. But a couple of factors there. You need to have money to buy the dip. So you need to have cash or access to cash to be able to time that. And I think we're mostly talking crypto here, but secondly, you don't know if it's a dip. You don't know if it's coming back up or if it's, if you're catching a falling knife. So it's tough to time the market. And I think you really should, not investment advice, not legal advice, but you really should take the long view. And so note investing is, you can diversify some of your, a lot of people that invest in our funds, they have cash, they have money in the stock market, but they want to diversify. So they put it in, they're not looking for a 50% return. I'm sure they would take it, but they're looking for, something with collateral could be considered safe. Good deeds. We touched on that briefly. We have control as note investors. We're able to use discretion and work with the borrower. In most cases, if they're willing to work with us, and we can, in a lot of ways, do good deeds. And we'll get to a couple examples of that. Control and security we touched on. There's collateral. I consider note investing one of the more recession resistant investment asset classes. I don't think anything is recession proof, but again, it's not correlated directly to the stock market. So to me, that's, that gives you the whole collateral and diversification. It's, as real estate prices are climbing, that the collateral value is higher, and it's not tied to the stock market. I just think it gives you some protection there. Anything to add on the recession piece?
No, no, I
Okay.
think,
Okay. I think another one then, it's a really big one that, and I will say, people oversell certain aspects of note investing. One
mhm,
that I don't think really, I think is definitely true is you can do this from anywhere. You can
mhm,
absolutely be a note investor. It's location independent. So I know Liz Broomer Smith, for example, I don't know, she travels in an RV and she's a note investor.
mhm,
So that's definitely possible.
mhm,
Getting started, where do you find notes?
mhm.
That's $1 million question. That's a tough one. I think
That
it's
is
a
a, oh, you can find notes. It's a question of, are they quality, and, what is the person, what are they selling and at what price?
yeah. I
Mhm,
think the answer I give a lot is, it's a it's a very inefficient
mhm,
market. It's a
mhm,
relationship business as much
yep.
as we like, certain online exchanges, and we think it could be improved from a efficiency standpoint. Um,
I think they're all awesome.
the fact is, you got to work and make relationships, and you mentioned something about, especially in these market conditions, becoming more of a hunter versus a farmer,
Yep.
and being more aggressive and going out and
Mhm,
finding deals as opposed to just waiting
mhm.
waiting by your
You
laptop.
like that one, don't you?
I
That
did.
is a good
That was
analogy.
good.
I read that. I'm like, oh, this is perfect. But
Yeah.
no,
I
it's,
mean,
you're right. It's
yeah.
all about building relationships. You don't want to, you don't want to ruffle people's feathers. You don't want to be, divisive in any way, shape, or form. You just want to go out there and build a network of people you want to work with, and make sure you understand, also understand though the people you're dealing with.
Yeah. And the one I'll throw in there that I underestimated initially, the one source is other note investors, or
Mhm,
other small funds that are closing,
mhm.
as opposed to going directly to banks and things like that.
It's the
Um,
opposite of what everyone teaches you, because a
yeah.
lot of people will teach, oh, go to banks, go to these large hedge funds and this and that. If you've got millions, yeah. But, when you're starting with 20, 50,000, you're much better off going off to other investors saying, hey, look, I'm looking to buy a note in maybe this locations. If anyone's got anything they're looking to move off their books, happy to take a look. And you typically could find something.
Absolutely. So we're not going to go too deep into the next couple bullets, but out of pocket financial commitment, it's definitely a capital intensive asset class or strategy, investment strategy. You need cash.
There's
Now,
no
does that,
conventional financing.
no, you can't walk into a bank and say, I want to buy this CFD down the road. Can you lend me 50 grand? I mean, you could try, but so eventually, if you're going to scale, you're going to need access to other people's money, at least. I don't know how a way around that really. And that can come in many forms: partials, joint ventures, funds. We've hit on all those before. So, again, people should go back and listen to those episodes.
Yep.
As far as partnership and mentorship, one thing that frankly gets overpromised a lot is, in the joint venture world is you're going to learn a lot. Oh shoot, I'm going to mess this up. But Russ of Wealth Without Wall Street, he has a saying about, you've heard when a joint venture, one person starts out with the money and the other person starts out with the experience, and then they switch roles. Basically,
Yeah.
I get the experience, and you get the money, but that's
No,
it's not
and
always the case. But you're not going to learn a ton in a typical joint venture if you're the money partner is what I'm
no,
getting at.
and I started, when I started doing some of my first ones, I was doing a few, and it's like, okay, you can learn and earn at the same time. And then as you grew, it's like, I was being honest with people, I'm like, it's just not viable because, when you're doing this from anywhere at any point during the day, hey, look, my attorney asked a question, I'm getting back to him quickly. It's like,
Yeah.
yes, I can copy you on that information, and, we can discuss it, because you should have some, understanding and also some decision-making abilities.
Oh yeah.
But the same token, certain things are just okay, or provide information. And they're like, well, why is that being provided? What's this? What's that? And it's, you get to a point where you don't have the time, really, and the
Absolutely.
timing isn't right. So when people promise you that, And, you know, I did it first because I thought I could do it.
Yeah.
You realize you can't,
Yeah.
unfortunately.
Have you ever talked, because I've, talked to a lot of people who've invested in or participated as partners in joint ventures. I've never talked to one who was the money partner who said, man, I learned so much. I mean, and I'm not talking about just us, but with anybody, it just doesn't happen.
Are you saying you didn't learn anything on 337 Nightmare Street?
I've actually been to that property twice. So wait, who was the day-to-day manager?
No. So right then and there, I just proved you wrong. You learned a ton from that.
Yeah.
So,
but
that was because your father was a listing agent,
Yeah.
So.
No, it was nice when we got a surprise profit at the end.
Is it still for sale, by the way?
Yes, it is. Unless it's sold in the last week, keeps dropping. No, I mean, I had Mike Schultz on a couple of weeks ago, and he talked about a joint venture with Dan Deppen, and he got a really good return, and he absolutely was spoiled. But did he learn a ton from that particular deal himself? No. I mean, it's just, and that's not to bash Dan in any way. It's, I don't, I keep my JV partners that I still have, I keep them informed, but I'm not actively trying to, train them. Okay. So 5 key decisions. I'm just going to list these because we're in the interest of time. We can. So 1, how active or passive do you want to be? 2, first or second position notes. Do you want to buy seconds? Do you want to buy only first? Do you want to do both? First theoretically can offer more protection. You're closer to the property, and then seconds are cheaper. They're less expensive. Well, you need less anymore. Capital generally.
Not anymore. On percentage basis, man, they're more expensive now, which is blowing my mind. But
the principal balance is normally lower, the average principal balance.
Yeah.
What states are you going to invest in, right? And I've actually bumped this up in my own, if I'm talking to people, I used to say 3 to 5 states. I'd say at this point, deals are hard to find. So I'd say pick maybe 7 or 8 states that you're open to buying in. Because if you're picking one state, you may not do a deal.
The biggest thing I'll comment on that is, that's a decision you don't need to make off the front. The first real decision when you go through these is, do you want to be passive or active? That's really a question you need to answer. The others come with education. But when the states you go to invest in, the biggest factor I look at more than anything is, do I have a kick-ass attorney in that state? Because if you do, like, New York, if you got a great attorney in that state and someone you can trust, it's not that bad if, again, depending on which part of the state. Where certain people, if you don't have an attorney in New York, I'd be like, I wouldn't even touch it. Same thing with like Ohio and Florida. You really need to have an attorney that knows what they're doing, because the laws are so, defined that if, in Florida, you don't have the note, or the, launches, you're kind of in trouble, and an attorney will tell you exactly what you need. And if you're dealing with some attorneys, like ones I've worked with in the past, they're more worried about, everything else, but your case from that perspective. So you just got to be careful.
Yeah. One thing I'll say is, again, you're right. You definitely don't need to have all these answers before you, become a note investor. And the one I skipped over is, should I be a note investor? I guess we talked about note investor versus, but even do I even want to? I think one thing people do is they just jump into an asset class, and then they never asked why. They never like, what do you, notes are cool, I'll do notes. It's like, well, why are you doing that? Think about it.
Well, there was a great post on Bigger Pockets yesterday where somebody went and was like, I'm going to do tax liens. And they were, spent all this money and did all this research. And then they were like, I'm doing Florida. And then they're like, Florida tax liens sell it like 0.25, not 25%, less than a point, 0.25%. Wow. And in Florida, if it's tax lien, basically you buy it, if it's not redeemed in a certain amount of time, that goes to tax foreclosure sale. So in this person, like, and Ned Carey, who's very, knows a lot of tax, he's like,
in Baltimore.
Yeah, he's like, this is why nobody actually really does tax liens in Florida. But this person's like, I can't believe I spent all this time and all this research and money, and this is what you make. And it's like, well, did you ask anyone? Like, like,
Yeah.
and again, you need to ask people who are actually in the business. Like if someone's telling you, like, and this is a prelude to my conversation that we're going to do on next episode, when people are telling you can make 6 figures in notes in your first year and you're going to make 100% returns and so forth, go ask other investors. And how many investors in notes do you know leave their full-time jobs to go do notes? When you look at it, it's not many. And then once you be like, well, why aren't they leaving? Well, maybe it's because they're not making what people are telling.
And I could, I mean, you can certainly be a good coach or mentor if you're not, Bill Belichick is not a very good football player, but he's very active in the space, right? He's not.
Yeah.
I'll just hit the last two, and then make it one more point about these top 5 decisions. Number 4, are you willing to buy contracts for deed or land contracts? And I've got a blog post about this, but there's pros and cons. I mean, I think they're oversold personally as the pros of, I get all this equity in the property because I just canceled the land contract. And, and typically speaking, the borrower is not walking away from all that equity if it's really there. So there's definitely more liability and more work with CFDs, but it opens you up to more potential upside and there more deal flow, for sure. Anything about CFDs real quickly?
Nope. But I want to challenge you on that Bill Belichick comment, but we'll get back to that another time.
Okay. So, no, but my point is,
we could have a great conversation on that topic because, I'll just give you a little prelude of, while yes, he's not a great football player, he is involved every single day in going through every scenario and plays it every week. And note investors who aren't buying or involved or watching how cases go, but just talk from what they learn on Facebook is completely different.
Right. Or maybe they did some deals 10 years ago or something, but but CFDs, I mean, think about it, whether you want to buy those or not. And then 5th is performing or non-performing. Again, it's not like you have to set out and say, I'm only picking one of these, but they're different animals. So are you looking for more? I usually use the analogy of a fix and flip property with a non-performing loan. And then a performing loan is more like a buy and hold rental property. Certainly there are differences, but what are you looking for? Are you looking for cash flow, or do you have a high paying job? I interviewed Ryan Harris. He used to make a lot of money in the NFL. Well, now he's retired, so he needs cash flow. And so he doesn't need he doesn't want a big payout in 5 years, or 1 year, whatever it is. But
what do you recommend for newbies? First note, you buying a performer or non-performer?
Oh man, I definitely used to say performing. I still would say performing in general. It really does depend, because you got to talk to the person and understand their situation. I think it depends on if they're looking for cash flow or not. How much time do they have? How much money do they have? Those are 2 key, and I'm redoing my website. And one of the things we're working through is it really comes down to active versus passive. And so we kind of closed the loop because number 1 and number 5 are pretty related. Performing notes, it's more passive, right? But are you looking for cash flow? I mean, the downside to buying a performing note for a newbie, just to get to your question, a couple downsides: they're more expensive. So it can go non-performing, and then you just overpaid for a non-performing loan. So you can mitigate some of that risk by just buying a non-performer out of the gate, but you can't just ignore it. So it's going to take a little more work. You were going to say?
And I'll use my quick answer of it depends, but really it depends on the person. And I say that because a non-performing note, when it's not paying, you always feel like there's a sense of rush or urgency. And if you've never been through like the boarding process and the entire process, you're rushing through it and you get antsy, and sometimes you're very aggressive. And on the performing side, you don't have that sense of urgency. So depending on, I think, your internal personality, most people are doing this the first time and they are a little, hesitant is the phrase I'd use. And if you add the hesitancy with the anxiety, sometimes you're better off, I think, on the performing side from a stress level of it's like, okay, I don't need to rush this because the person's making their payments. Where if they're not, it's like, okay, time is money. I need to get this boarded. Why isn't it getting boarded? I need to file foreclosure. I need to go demand. I need to do this and do that. And time is money. And you're constantly checking every day and what's going on in the portal, and you're going to drive yourself insane. So from that perspective, you know, depending on the type of person, especially if they've never really done real estate.
Well, that's what I was going to say. Depends on their experience, right? If they're a 20, 30-year veteran in real estate investing, fix and flips, rental, maybe they should buy a few NPLs if they've got the time. One last thing I was going to say on these 5 key decisions, and there obviously are more than just 5 that you need to think about, but it doesn't, there's no particular order. But this can seem overwhelming, I think, to people that, like you said, they're hesitant, right? And because it's a whole new world. And one thing I will say, though, that's kind of comforting, you mentioned the attorney on the ground, right? In that particular state. As you start to answer some of these questions, the other ones kind of can fall into place. So, you know, how active do you want to be? Well, that can get to number 5 about non-performing. So they're not all, you know, start with your what you consider the most important questions to yourself and most important decisions for you. And then the others will start to fall into place. And, you know, people get wrapped up on, I need my team in 50 states. And well, no, if you picked 3 states, make sure you have attorneys in those, or even one attorney that covers those 3 states. And you just checked a couple different boxes. Actually, I'll share my screen on this one.
I didn't know if you wanted to go through the case study, or did you want to leave it for people to kind of have to go watch cash flow? I'm not going to,
we were running out of time, but I think I've got 2 case studies on here. One is our Jacksonville case study that turned out to be a really good win for us. And it was a NPL turned deed in lieu turned rental property. And we still have this as a rental now. We did a long distance rehab. We actually just did a cash out refinance, so I'd already gotten all of my money back out and then some. And then we just did a cash out refinance on this. So this was a big win. And it was a way that we talk about good deeds, you know, I guess tooting my own horn or whatever, but there were a lot of ways where the borrower actually, and the occupants are in a better situation now. The home is much improved. We added value to the neighborhood. And then, you know, we profited, and we are now offering affordable housing as a rent in the form of a rental property in Jacksonville. So there are a lot of ways that things were improved on that one. And
Can I make my shiny squirrel comment?
Yep.
Are you using Windows 11?
Yeah.
You like
yes,
it?
I can make it. Oh.
Squirrel. Keep going. Sorry.
I do so far. Yeah. All right. So you can go back and I've got a blog post about this on my website, but it's not updated, labradorlending.com. Second case study. So this is the subperformer I was referring to. So this borrower was paying consistently. I mean, probably for 2 years straight, if I went back and checked, but she was on a government assistance, and, you know, but she was 2 years behind, but she was making consistent payments. So she wasn't 60 days behind, and she wasn't one of these lumpy payers. But I personally, I mean, she's 2 years behind. That's a non-performer, but there's obviously, you know, there's communication and willingness on her part that she wants to keep the property. So chances are in that case, in that scenario, you're likely going to be able to work something out with the borrower. You can see the numbers here for those who are watching on YouTube. And we were able to turn this around, modify this loan. We bumped up the principal balance. We forgave a good bit of arrears and for her. So we lowered her payment slightly. We lowered her interest rate from 11% down to 8.5, forgave a lot in arrears, and extended the term. We were able to sell this then for a good profit. And now, again, this was more active than passive for us. But I was able to sell this to a passive note investor who now holds this in his self-directed IRA. So the borrower won, we won, and another note investor won. So that's one thing I really love about note investing, can be win-win-win. So yeah, here's some more of the numbers. And
They're good deals,
yeah,
good deeds and good deals. So
yeah, anything to add on those two? The Jacksonville I really like because it involves so many different, there's a lot going on.
Yeah, I mean, the only thing I'll add kind of to this whole topic of conversation as a note investor, for me, what I love about it is the challenge. And what I mean by that is this is not the business where, you know, everything is clear cut and you know the ending or where things are going to go. You know, it's just like doing a fix and flip or anything along those lines. You know, there's the road you take to get there, but you're definitely going to be, you know, knocked off the road and wander. And what you think may happen may not. But I would say, you know, you typically do play the odds. And what I mean by that is, like you said, if the borrower's got 100,000 in equity in a property and they're a year behind because they lost their job, you know, they're going to file bankruptcy 9 out of 10 times. And that's probably the play you should make from that. And if something else happens, then it's like, hey, something else happened. But, you know, it's, you know, kind of like on, you know, back to football, you know, if it's 4th and 12, you know, on your own 20-yard line, you know, odds are you should punt, you know, in that essence, not really go for it unless you're the Chargers, who, you know, typically do. But, you know, because the odds are typically against you. So, you know, you have to think of it, you know, kind of like, you know, gamification in that sense of understanding, you know, and put yourself sometimes in the borrower's shoes. So that's my note and bolt as well for today.
Oh, covered it. I like the gamification. Somebody just tweeted, you know, successful people treat life like a video game and unsuccessful people treat it like watching TV. You know, it's like, you're more active and creative versus just consuming. My note and bolt, and then we'll wrap up. And then next episode will be Chris's turn to get picked apart. So my note and bolt is, when you're doing a loan modification, I've found success in providing the borrower options. And you hear this from people who, like wholesalers and people who buy property, they give the seller options. And I'm not a sales guru, but I think, you know, it gives, as long as those options all are good for you and you can still profit, it makes sense to provide, you know, one that, like, for example, I provided 3 options for this one that we're doing in New York. And the first option is, I think it was $15,000 or $20,000 down. I'm pretty sure that wasn't going to happen, but I would love for that to happen. Right. So they ended up taking option 3, which is the least amount down, $2,000 down, but a higher interest rate and higher payment, and less that I'm going to kind of forgive in arrears, but it gives them a sense of control, and it gives, you know, more flexibility. So I know people do trial payment plans, either formal or informal. I would just say, just consider that at that point, when you're offering a loan mod, you have the ball is in your court to present options. And so I've been having success presenting at least 3 options to the borrower. You don't want to make it too confusing, but don't just pigeonhole them into, you know, reinstate or get out.
And I like to add, as part of my membership group, people get used to my calculator that shows loan mod options and what your returns are, as well as another calculator that shows the different, you could put the loan up there and put the different amounts or different interest rates, different payments, to kind of put them side by side to kind of see what the difference is and what they look like as well. And you could use that to send to the borrower and say, hey, here are the 3 options. And it has the amortization schedule, and basically be like, here, go pick one, so they can understand it.
Nice.
So
I like it. All right.
Self plug. So
yeah, like I said, we don't do that enough.
No, we don't. So
yeah. So you want to take us out?
Yes. Well, thank you everyone for joining us on this episode of the Good Deeds Note Investing Podcast. Make sure to follow us on your favorite listening station, which now there seems to be about 50 of them. So, and please leave us a review on iTunes. And as always, go out and do some good deeds.